What's up, everybody? What's going on with all the outliers? Happy Monday. We are not really doing a whole lot because we have a closed market, but the futures are starting to turn on a little bit here. And then there's a few things on the agenda. But before we start getting into the weeds here, I am going to grab the chat so that I can keep up and say hello to everybody as we move along. So far, it looks like we have Reese and Mike. Great to see both y'all. Reese says, contemplating taking profits a little earlier than I otherwise might have given expected volatility with elections. Curious if that's prudent or myself justifying cutting winners too early. What a great question. And honestly, very, very self-reflective. So props to you for thinking in that light, because it's something that most people tend not to. And I am going to grab a paper for us to take a look through together to talk about this exact thing. So one of the things that Reese is accurately highlighting with his question here is trying to better understand his perception of whether or not taking the loss or taking the profit here makes sense, or if he's essentially committing part of what we call the disposition effect. So if we take a look at number 2 from this paper that I cannot recommend enough reading, is called The Behavior of Individual Investors. And the whole idea here is to better understand the way that essentially we work internally as individuals. So when I'm looking at this, there's 2 things that Reese is talking about that makes me curious. And let's start with the simpler one. So Reese, the first question I would ask you in this scenario is, what was your plan when you put the trade on? So when you initially placed the trade, what were you thinking? And be honest, if it was, I wasn't thinking through all the way, that's totally cool. We've all done that. If it's, I wasn't expecting to hold it this long, or whatever it is, just tell me whatever you were genuinely thinking when you first placed the trade. We also got Joe Tato, which is, honestly, it's a pretty fun name. I don't know what that's modeled after, though. You have to explain it to me, the background behind your name, Joe Tato. Big Ace is all over the disposition effect already, which is spot on. And then we have, whoa, we got a little feedback. We don't want that. Then we have Zachariah. My name is Joe, and I'm a potato. I guess that would summarize Joe Tato, to be honest. Like, okay. Yeah, that's self-explanatory. I honestly maybe see, you guys have me too primed. I'm looking at too much GameStop stuff, and now I'm looking super deep into Joe Tato. I'm looking at the syllables. I'm really trying to understand your childhood from the term Joe Tato, but it's very straightforward. You know what, Joe Tato? Here's my hypothesis here. I think there's a deeper meaning under there that you don't even know what's in there. Yeah, exactly. See, I knew it. I knew there was more meaning. You see, Joe Tato, like me, has chosen to block out a lot of his childhood. That mental compartmentalization works great. So my guess is that your subconscious is giving us a message here. I don't know what it is. We might have to figure it out over some time. But yeah, I think there's more to this story than what's being let on right now, Joe Tato, because I bet you're not just a potato. Joking aside, Reese follows up, says, I hit my first profit target, was going to hold out for a bit more for my second target, but I'm just shy of it. Okay, so let's dive into that. So talk to me about your plan. What was your plan when you originally placed the trade? You hit your first profit target. What was your plan at that point? Was your plan to wait until the second profit target? Was your plan to take some off and wait until your second profit target? Was your plan to set some sort of stop? What was the plan? Now, the reason why I'm walking through this process with Reese is because we literally all do this. What he's talking about is so unbelievably common. And it's a trait that a lot of us have as traders until honestly, we just bake the habit out. It takes a while to break that habit, but it can be broken. So with this specific example, we're kind of in a bit of a mix, right? Because Reese is saying that he had a plan, right? So part of his plan here, as he's highlighting now, is took some off, which I did at target 1. Okay. So then the question I would follow up with is, what was the plan after that? So I'm pulling Reese through a journey, and I'm taking you all on the journey with us. Also, I have a question. Do you like the background better like this, or do you like it like this without the background? I ask because I can't tell if that movement, like when I move my desk, if that's like super annoying or not. For me, it might be. I don't know. But I'm taking Reese through this kind of path because we can learn a lot about the way that we plan trades. And one of the things that you'll hear from me specifically is my genuine opinion towards trading is that whenever you're actually physically trading, that should be the easiest part. It literally should be the easiest part of what you do is when you are actually clicking the button, sending trades. The difficult part is all of the homework and research that's done before you ever click the button. So for me, whenever I'm in the process of managing a trade that's on, and we'll talk about a couple that I have on right now, it's simply applying Bayesian analysis. So updating the probability matrix I have going on in my brain based on recent information. And then I'm simply trying to see what part of the path I'm going to follow, but the path is already generally predefined. Reese says the plan was to hold for zone 2. Okay. So then what about the election, which really still doesn't impact the markets just yet? What part of the election then has you thinking that there's this new expansion of volatility that then makes you think you might want to consider not following that original plan as laid out? Because if the plan was to hold for zone 2, then, and we knew, I guess the part about like economic data and stuff is like, we already knew that that was the scenario here. I see. So you said you're condensing it to the election. Yeah. So in this scenario, though, I would look at it as when you put the trade on for whatever duration the trade was on for, you had to expect that new stuff would come out over the life cycle of that trade. So the fact that new stuff is coming out over the life cycle of that trade shouldn't be surprising us. So then the next question I would ask myself is, if the plan was to hold for zone 2, that's part of the plan. But what was the condition then that would lead you to not hold until zone 2 and to close? How did you define that? Because again, what Reese is talking about here, and I can tell by the way he's framing it, this is the way, again, it's one of the most common behaviors I see with traders. And Reese is a great sport, right? So he's going through the example with us, but he's exhibiting one of the most common things I see in traders that sabotages them. Can any of you guess what it is? Just look through the path of dialogue in the chat there and tell me what you see. There's an important perspective that's being taken that's actually blinding us a bit here. And also, because I know that we now have a more gender diversified chat. Normally it was just dudes, but I turned the air on instead of taking my shirt off. So I'm refined. I'm literally a reformed human being that we're doing live streams with shirts when I'm slightly over temperature. Is I just turn the air on instead of popping the top off. H says respect to Reese first off. Yes, that's absolutely solid. H says Is it wanting to manage winners early? Nope, that's not it. Zachariah says uncertainty, lack of data. Great question, but also not it. Jotata says, I also feel like taking winning positions early is the answer. That's also not it. So notice the entire decision cycle, right? So if we go from the top, contemplating taking profits, right? Then we have, why did we do that? Because we hit the first profit target and the next isn't guaranteed. Then after that, I said, well, what was the plan at step A? Take off target 1, which was done. Then I asked, what was the residual plan for the remainder, which is to go to zone 2. Then I asked, what new information made him feel like there was now excess risk compared to what we started? It's this idea of economic data. So everything that we've talked about here is looking at the profit. Everything. Every part of this trade, other than acknowledging the fact that the next target, which is also profit, is not guaranteed, we haven't discussed managing risk. So the reason why this matters so much is because the decision to take the trade off or not, in my opinion, has to be baked in the expected return of the strategy. So let's get the handy dandy whiteboard out, or blackboard, I guess. It might take it a second to load up, but first let me drop a link to this study in here for you all, which I think is really important there. And then let's let this blackboard load up. And well, maybe, I don't know if it's, there it is. Okay, great. Here we go. Here we go. All right. I know everybody's excited for this. I'm realizing that this is probably the most important part of our time together, are these drawings that, I mean, from what I've been told, these drawings do everything from enlighten to invoke strong emotional responses and make people, see the world in a new way. So I aim to achieve that here, except my little tablet's not working. Give me a second. I use this thing. I don't know if you guys have ever seen one of these. It's kind of cool. And it's also hilarious because the thing that I use is so expensive for what I actually need. It's like legitimately comical. And then from here, I need to grab this. Oh, good. The driver is not responding. That's always my favorite. So let me try unplug one more time. Let's see if this works. If not, I will navigate into the next. Kevin says, are you related to Picasso perchance? Maybe in like the construction of my face might be related to Picasso. But beyond that, I wouldn't think so. Yeah, I probably wouldn't think so beyond that, if we're being honest. Okay, so this is probably going to be a little bit painful because I can't undo with the tablet like I normally would. Like there's typically hotkeys that work, but they don't now. So I have to use the keyboard. So bear with me. Okay. So let's start with this trade. So where is Reese? Reese says, I have a hard time with probabilities because we all think we're going to win, so I can't be 100% objective. Aha! That is actually, I would argue, the exact wrong way to look at it. Because I don't believe it's a binary outcome, and I literally will show you how you can use options to come up with a slightly better way to approach this exact problem set. So I'm glad you brought that up. Let's talk about it. Okay, so Reese, give me the original parameters of your trade. So you told me we have 2 profit targets. So first off, let's use, I don't need to know the size of the trade. It doesn't matter. But we have profit target 1. Oh boy, this is going to be painful like this. Oh my God, what is happening? Might be the bracelet. Hold on. Let's see if I can fix this. See if we can get our acts together. No. Oh no. All right, gang, it looks like the whiteboard might be out of the equation because this thing is straight up not working. This is not working. Zachariah says Wacom is an awesome company. It seems like it, except like their little platform's not working. Okay, let's go. Maybe I just have to type lighter. So profit. Oh, what's going on here? Profit target 1. So Reese, tell me what we were going to make at profit target 1. And the text is good. Maybe I'll just do it with the mouse. That might be even better. That's probably not better. We'll try it like this. So Reese, at profit target 1, how much were we going to make on this trade? Any ideas? $100. Cool. At profit target 1. Okay, now at profit target 2. I don't know why it doesn't like this motion. There we go. Okay, so profit target 2. Okay. I'm just going to try with the mouse. There we go. So in case you don't know, the mouse is going to look even worse because I use like one of these weird mouses, but it looks like it's what we're relegated to because this the little tablet's not working. So you telling me we're going to make Reese, this is 150. So the total, were there any other profit targets in this trade, or are these the profit targets that you had? Profit target 1, we were going to make $100. Profit target 2, we were going to make another $150. Was there a profit target 3 or 15? Lord help us if there's 15 profit targets, because there's no way I can essentially write this. Another one. So there's a third profit target. Okay, well, I think I can get us through 3. Roman numerals would have been better, but that's fine. So profit target 3 was going to be $200. Oh shit. Okay. Okay, this is great. So now, Reese, talk to me about the loss side of the equation. Before you hit profit target 1, what was the risk on your trade? That was a good line. That was a really good line. Drawing that with the mouse, especially because, like I said, I got one of these thumb mouses. That's not easy. That's art right there. So, Reese, how much were you risking to get to that $100 profit target on this side? Thank you, G36, for the credit, because I really needed it. 250. So this is our risk side. Okay. So now, Reese, what is our risk for profit target 2? I'm rounding a bit. Yeah, that's totally cool. 100% cool. What I'm going to walk you through, for those that don't know what's going on, just so that you can like read between the lines and like see from my eyes. I'm literally going to walk you through how to turn this into an expected return, so that whenever you deploy this strategy going forward, you literally can just do it via, actually even better than this whiteboard. I'm going to do it in a Google workbook so that you can follow along with me. I just realized I don't have to be selfish and just enjoy the process of writing, because I'm essentially a genius at it. I'll share this with you here. So this is just going to be, and literally you can follow along at home. So trade 1, we have profit target 1, profit target 2, profit target 3. And then here we're going to have our profit potential, our loss potential. So again, if you feel like following along, go for it. I'm not going to worry too much about editing, although I do have, as you might be able to tell, a bit of OCD. So I do like things to look a certain way, but we'll try to keep it to a minimum. So profit target 1 was 100. Profit target 2 was 150. Profit target 3 was 200. And then, which these numbers are very, very clean, which makes me curious from the jump. The loss for this first one was negative 250. Profit target 2, Same risk, long calls with some short calls. Okay, so this is also negative 250. Oops. 250. And then profit target 3. Same thing here. Same amount of risk. G36 says, damn, bro, you edit those cells like a boss. As much as I would love to take that credit, I mean, I do. Like, yeah, I'll take that credit. But more importantly, I think it's a artifact of just what I'm able to carry over from my skill set in drawing. Same up here. Okay. Negative 250. Okay. Now, what I need to know are some more details. So first off, I need to know the underlying, and then I need to know the date that we got into, date of entry, that we got into the underlying. And then I need to know the spot price when we entered. So talk dirty to me. Give me some deets here. First thing I want to know, underlying, date of entry, and then spot price. And then in the meantime, cheers. I'm going to drop some acetaminophen. We're leaning off the ibuprofen at this point so that my internal organs don't shut down. And now we're just abusing acetaminophen, which abuses another organ. I can't remember if it's the liver or kidneys. I know ibuprofen fucks one of them up. Acetaminophen fucks the other one up. So I'm trying to alternate between which ones I'm fucking up. That's the idea. So this way, all the organs can get it. Reese says SoFi. Okay, great. SoFi. And the date, what was the date? You said July, but there's quite a few days in July. And again, by the end of this, you will literally have, like, you literally can copy this. And you can use this. I can kill this now because this ain't going to work for me. No, I don't want to say that. And then you literally can use this to solve this problem for yourself in the future so that you are making an educated decision. G36 says acetaminophen is liver damage. Okay, perfect. So then acetaminophen, liver, ibuprofen. I've heard it's gastrointestinal. Apparently I have just an iron gut because I didn't notice any of that. And I literally took it an egregious amount for like a month straight. So, but I think that one's also then kidneys. One of them fucks up the kidneys. I'm pretty sure the liver can regenerate. So, I mean, what are we even worried about here? Reese says I scaled in. G36 says a month isn't too bad. Honestly, I never take pain. I literally don't take pain meds. I didn't take them after I herniated the disc for like 3 days because it didn't even cross my mind. So to me, like, it feels like an eternity. Reese says liver and kidneys work together. So both, man, y'all are, I'll show you. I looked this all up on ChatGPT to tell me which ones I was breaking. Wow, I asked ChatGPT a lot of questions. I don't know where it is. All right, I'm not going to get off task. I'm going to stay on task. G36 says, sorry, I'll try to stay on the topic, but I love drawing. Yeah, no, I'm fascinated because your boy right now is on a fucking cocktail of them so that I can stand up straight. Okay, we have this date of entry. I don't really care. Okay, so then talk to me, Reese, about these profit and loss targets. So where was stock price? Where is your profit target 1? What price does that occur at? And then I'm going to ask the same for profit target 2 and profit target 3. For those that are aware of what I'm doing, can you tell the chat what I'm doing right now? Because I saw Tom was in here. And Tom, if you don't know what I'm doing, I'm literally going to be fucking furious with you. So for those, sometimes people are really curious about the way that, like, I interact with different people. Some people are wondering, like, they wonder why I'm so nice to some people and then mean to others. And what I try to tell people is it's kind of like it's based on your skill set and requisite expectations. So somebody like Reese, I can tell is, getting used to this stuff and figuring out his approach. I don't know him that well either. So I don't know how long he's been trading and stuff like that. So I obviously will approach Reese softer. Somebody like Tom, I've known him for a long time and I don't give a fuck. He can get it along with anybody else like that. So Tom should know exactly what I'm doing. But G36 says, are you determining risk reward profile? Very, very good guess. Something similar to that. Reese says, where the stock price is or the option price? Great question. The stock price. So Tom says, I'm multitasking right now, but looking at this, it looks like expectancy. Nice job. That's exactly correct. I forgot. I took away emojis or whatever. So Tom, you get plus fake one internet point. Here you go. That's for Tom. You get one of those. Plus fake one internet point. Pretty sick, huh? Mapping risk reward per underlying price. That's very close, Liz. Very, very close. Okay, so Reese says stock at 8 for this first one. 8. $8. Give it to me for profit target 2 and profit target 3. Dr. Zayas, can you zoom in on your sheet? Yep, you got it. Listen, I'm a people pleaser. Damn. If you can't see this now, this is like geriatric level. This is nuts. This makes me honestly uncomfortable. 8.5 and then 9 is what we're saying. Okay. So then where is your loss point for all of these since it's the same? G36 says, Eric, the people pleaser, want to send me 100K would be very pleasing. Honestly, G36, if you spelt my fucking name right, I might have considered it because I'm wiring a bunch of money this week. But now I'm not going to lose $100,000 because, I mean, what the fuck? We've been around each other long enough by now. Yeah, close but not quite, dog. Reese says I would have cut them at 2. So my risk was only 46 cents. No, the stock price. Because with them being at 2, we need to determine what the stock price is at 0.46. Dr. Zay says that's a demerit G30. I agree. Hold on, I got to find a demerit icon. Like a good demerit icon. There we go. This is a pretty good one. This one for G36. There we go. So Tom is asking a literal fantastic question, and one of the ones that I'm going to start with. G36 says, does that mean I send you 100K? No, it just means that you get one of those, that demerit right there. I think that's, we got plus 1 fake internet point and then -1 fake internet point, aka +1 demerit. G36 says, how did demerits work? That's a great question. It's kind of like figure it out on the fly. We'll see how many you accumulate, and then we'll determine the proper course of action to remediate is the idea. Reese says, I got 6 points Friday and 0 emojis. What the fuck? I just learned how to do the emojis, so my bad. Going forward, we should have a slightly more well-rounded system. So back to this. We know the profit target here was at 8, 9, and 9.5. So Reese, where was the stock price for the loss? Stock loss target. And then normally for me, I would kind of write it like that. I'm just writing it out so that you can see what it is. 6.5. Okay. Great. All right. So what I'm going to do now is literally walk us through how to calculate an expected return. Reese, give me the date of entry for your first leg here. I don't really care about the scaling in. I'll just pick the first day. We can start from there. July 18th. 18 July. I made that up. That's fine. Make it up all you want. That's cool with me. This is your trade and your money, not mine. So however, as you could tell, I'm not trying to fact check anything. Like, I don't really care. I'm just going to do the math. And then if it's based on good information, then it's based on good information. If it's not, it's not. Okay, SoFi. Let's take a look. So we can squeeze this down. And on July 18th, I guess this can go over here. And June, July 18th. Damn, you like top tick this, homie. I have to be honest with you. I applaud your timing of this because it's about as shitty as my timing is. So I love this for you. This builds character right here. Making sure that whenever you buy something, it's at the very top of recent term highs after a parabolic run up. That's perfect. That will definitely make sure that we have a little bit of grit in our lives. So now what I'm going to do is the working investor says, don't hate GameStop, just want to see a variety of videos. Dog, I do a variety of videos like every week. I don't understand why people think that like all I do is GameStop. Even on the daily update videos, it's not about GameStop. GameStop gets one live stream. Then the Monday, Wednesday, Friday live streams are non-GameStop. The Saturday video is not GameStop. The Wednesday podcast video is not GameStop. Shit. I realize the longer I'm on this platform and the more time that I put into stuff, I gotta be honest. I realize it's impossible to make everybody happy. There's a lot of time and effort, dog. June, July 18th. Let's get over to this top tick day. Hell yeah, that's a good top tick. Just bang that right at the top. So we'll call this spot price. Well, now the math isn't working out already because of where these things are at. I'm confused. You said you made the date up. So Reese, if you didn't make up the date, give me the damn date. Otherwise, I can just guess, right? So if you told me you got it when it was 680 something, we could guess that it was like the 12th maybe, or the 11th. Either of those work. Yeah, G36 is on it, man. We need the damn date, Reese. Reese says I paid $246 for the options. I don't know the exact spot. Look at your... Oh, my. Unbelievable. Okay. Okay, Reese. Okay, Reese. We'll play your game. We'll play your game. So you told me now I need to figure out the option because now I have to play this game. Love this game. Is deconstructing what this trade was. So what is the expiration for the long calls? You told me that the strike, you didn't even tell me it was for January. Okay. So we have a 5 strike, 5 Jan long call. Fine. And this is not supposed to be a date. Doesn't matter. Okay. So what I need to do now is, because it's far enough out in time, I already know the date because there's only going to be one expiration out there. So I already know that. I can then find the price, which is $5 here, which would have been before here per my estimates. So then I'm going to go to the 12th, which is my follow-on estimate based on the original statement that the stock price was at 680. And then we will take a look at what these 5s were trading for then. You know, just because Reese can't recall the date, now we just have to fucking reverse engineer it. That's what we're doing right now. Now, honestly, I really don't mind doing this because I think it's helpful for people to see. The reason why I show this is because with just a few small details, you can find a lot of shit. So in this case, I can generally figure out when he would have gotten into these based on what he told me he got them for, which he said that he got them for 2 and change, which is actually shocking because 247, it would have been like maybe on the 9th. It would have been almost on the lows. But this position really started in July. Yeah. No, I believe you that it started in July, but where in July matters because that's how I'm trying to determine. So what I'm doing now, again, just to explain the process here, is I'm actually going back to the 9th to where I can see that we had this low, and I'm going to see if it occurred on the low, because if it didn't occur on the low, then there's data wrong, and I will be able to decisively estimate that, right? So because he said he got it for 240 something. So it could have happened today is what I see, right? Because right now we're at 632. So let's go a little bit earlier or later in the day, I guess, maybe. Oh no, it happened before. So it would have been towards the open. And we can just call it somewhere around here. This is totally fine. Reese now adds that there's one in June. I asked you before, Reese, when was the first trade? See, this I cannot abide by because I am happy, more than happy, to look through the trades, but I ask my questions specifically because I need specific information, even few data points, to arrive at these answers. And now Reese is telling me that instead of July, it's fucking June. Who knows? Maybe it was January that Reese first got in. Maybe it was then. Because what I can tell you, actually, straight up, is when I look at this, Reese says that he got his first position in June for $1.90, and I actually don't know if that's fucking possible. Let's go here. Let's go to the 21st of June. I can fact check that for us. And there's another way to fact check this, by the way. I'll show you 2 ways to fact check this. The easier way to fact check it is to come out of on demand, to come into this expiration cycle, to grab these 5 calls in 16 Jan, and actually to dump them on a chart, quick chart. So now I can see the prices. So I can see the prices going all the way back. The cheapest these have ever traded, Reese, were $2.31. Reese. Fucking Reese. So, I've been lied to, Reese. I started this conversation on trust and belief, and Reese did me dirty. So now, we'll just use like a fake example just because I don't want to spend, an egregious amount of time. I really want to show you the process I'm trying to follow here. So let's say in this case, G36 says demerit. That's actually a great point. So hold on. I got to find my demerit thing. This is for Reese. Reese gets 1 demerit. So now we'll just go through like a hypothetical scenario at this point. So let's say that originally our stop loss target was 650. So let's figure out a time where that would have made sense. We got in supposedly when it was 680 and 650. So let's call it somewhere in here. Let's go to let's play it from the 15th of August and just use this now as a hypothetical. I was trying to use Reese's actual position to try to help him out at the same time in the analysis, but this in general will essentially help anyways. You'll just have to apply it directly to your scenario. So what I'm going to do now is I'm going to use the power of options to help me understand the expected return in all of these scenarios. Because here's the first thing I can tell you. The first thing that I can tell is that the probability of profit here at $100 and the probability of this $250 loss, I can tell you we need a high probability of hitting this. And based on the prices, if the stop loss target was at 650 and we were going to lose 250 versus 680 to 8, this is negatively expectant. I can tell you right from the jump without even following through with this. I literally can tell you right from the beginning. So what I'm going to do is actually get rid of all of this and create a fake position to show you what this looks like. So in this case, let's say we can keep these profit targets of 8 and 850, and we can keep this stop loss target of 650, but I need to see exactly what it would be trading for. And damn it, I wish I could, I wish I could show you. By my house, right outside my window here, they launch hot air balloons. So we get to see them float up and like over the valley behind my house because we live right by a big nature preserve. So we have like no neighbors right behind us. It's actually really cool because you don't get a lot of those in Southern California. Normally it's just a mob of people around you. But the hot air balloons are going up right now, which are sick. So I'm going to come up with a surrogate position here for the example. So let's go into this trade. I'll use the same one, but we just need to use, obviously, these are the examples from the other day. So I'll get rid of those. And let's analyze this. Let's get rid of this. Okay. So now what I'm going to do is identify what the profit and loss would be at these different targets. So in this case, if we take a look at the profit, if we get to 8, we make $69. So we grab our 69 bucks. And then profit target 2 of 8.5, we would get $111.2. So $111.2 Dollars. The reason why I said Dollars is because for those that don't know, Tom is Spanish in heritage. And because I'm clearly fluent in Spanish, I like to be inclusive for him. So Tom, I hope that just your mother tongue sounds good coming from me because it sounds good to me. So now the stop loss target at 650. At 650, we lose 52.76. So minus 52.76.76. And we need more decimals. And then this would be the same, 52.76 minus 52.76, whatever. And let's copy that formatting. Okay, so now we need to do stock profit probabilities. So normally I would write this as like probability of profit and then probability of loss. Grab that, grab that. All right, I'm taking a pause here. Does this make sense so far? What I've done is I've figured out what the probability is. Well, I'm going to figure out what the probability is for profit and loss. I already have the targets here and here. And I already now know from using, again, the power of options to tell me how much I make and how much I lose at those different points. So now there's one other piece that I need, these probabilities. So before I do it, there's a few different ways I can get these probabilities. Give me 2 of them. What are 2 of these ways that I can get these probabilities? Reese says, aren't all long calls negatively expectant since you need the stock to go up significantly? No, that's not accurate. That is incorrect. Yeah. Because you don't actually need the stock to go up that much. It's not fully accurate. We're already done with our mango spindrift. Now we have our reserve Waterloo blackberry lemonade. So crack this bad boy open. No guesses, really. So there's two ways. This is actually really important. So I want to make sure you know how to get this information. So walk me through two ways. There's two spots. One of them is specific to this platform. Exactly. Tom is on it. So the probability tab. So the probability analysis up here. Exactly correct, Tom. Thank you. And then there's another one where GME just hit 80. Okay. Pause. If GME hit 80, we need to see that. I need to turn on after hours. Give me a sec. G36 says GME isn't trading currently on any exchange. Oh. You son of a bitch. You made me completely abandon knowing that as soon as I hear that kind of information, I'm going to drop everything to go look. I was even going to modify my chart so that I could see it, to only find out that I've been double lied to. You know, I'm starting to lose trust here. This is 2 times now I've trusted, and 2 times that I've gotten fucked up. Who was that? Fragile whatever. Hold on. This person here. This one. You get one of those. Unbelievable. G36 says double demerit. No, we do singles. We go directly and fairly across the board unless there's an egregious act, but single demerit warranted. So now let's get back to the example and let's get back to what we're doing here. We're going to now use one of 2 tools to assess these probabilities. The first probability that we can use, exactly as Tom already said, is the probability analysis from this probability tool. Now, I don't know how accurate this is in on demand, right? Because we're back in time. So I'm not actually going to use it in this case. Let me see if it's actually okay here. Yeah, I'm not going to use it in this case. Now, the other way we can do it is literally just from the options chain. We can look at different time periods that we think this could happen in. So now, normally I would ask Reese, but I'm not going to because Reese has been just sending me down rabbit holes. So I'm going to make it up. Normally, when I'm trading long calls, I'm going to pick a time frame that I need to do something by, right? Because long calls do, even though this one's 519 days out, it still is going to decay, albeit slowly. I don't want to hold it that whole time. So I'm going to pick a time frame to management. So DTE management. And in this case, I'm going to use this 36 days for management. And I'm just picking it because it's the next primary expiration. So what I'm going to do is use the options to give me the probabilities, because that's all options are. They're probabilities. So if I take a look at the probability of us hitting 8, all I need to do is go to 8, and then I can look at what is the probability of a touch. The probability of a touch to 8 within this time frame is 26.41%. That's how I get this probability. So 26.41%. Then I need this other probability of hitting 850. So I can then take essentially the midpoint between these two probabilities. So 26.4 against 11.6. So we can just throw that here, 26.4, 11.6, and then you can just average them. So in this case, the average is 18.9. So that's what I would use here, 18.9% probability. Guess what we have to do for the losses? Same exact thing. That's it. That's all that we have to do here. So we take the probability of 6.5, which is the difference between 6 and 7. So in this case, it's 48 and 75. The reason why it's 75 is because the sevens are already in. So we take our 48, 48.4, and then our 75. We figure out the average here, which is 61. 61%. 61%. So guess what? We now have everything we need to create this expected return. You can do it in a few different ways. You can do it in a ratio, or you could do it as just a raw number. So what we would do is take our profit, our expected profit, times the probability of hitting that profit, subtract our loss times the probability of that loss. Oh, sorry, wrong screen again. There we go. We're back at it. My bad. I popped over to the side screen, clicked the wrong button. But you can see the expected return for these. So in this case, it's still a positively expectant strategy. Now you can take a combined expected return using these different profit loss targets, but this is exactly the way that I would go about creating this calculation. Because we're using stops, I use the probability of a touch. And I literally can go through and decide what makes sense. So then again, going back to Reese's example, if Reese tells me now, okay, if I take the early probability of taking a smaller profit, let's say instead of this $110 profit, we want to take it at 75. Well, that will change the probability of us hitting it, right? So maybe, oh, I forgot, these need to be plus because these are negatives. I was wondering why that was wrong. So I realized as I was looking at it that the numbers didn't work out. The issue I had is because the way that I formatted it, because these were negatives and I subtracted it like I typically would here because I normally wouldn't use negatives. It was doing it a double negative and adding it as a positive, just so you know what was going on. So if I grab that back and see the initial probabilities so that you can see them accurately, because that, yeah, I was surprised because it didn't look right to me. There we go. So now we know that this is a negatively expectant strategy, or at least the way that we're looking to manage this long call. This would lose money. So the next step is we can analyze this second profit target. So we can say we took the profit here, we made whatever money we did, we made the 69 bucks, giggity. And just because it's negatively expectant doesn't mean that it won't win sometimes, right? So this one was realized, and it was realized at that handle there. And then this one, now we're saying like, okay, do we want to take early profits? Well, let's say we want to take a $75 profit. Okay, so now I can update my probabilities. So I can say, go into analyze, go to the risk profile. And again, you can do the math here. You don't have to use the risk profile. I use this to make it easier for you to see. So if we go to 75, that means we essentially need to hit $8.36. That would be our new target. So $8.36 would give us, again, the early profit of 75 or whatever. Now, one other caveat, as time changes, these probabilities would change. So this scenario would be slightly different. I can fast forward it a little bit so that it's a little more realistic. So let's go forward. Today's September. I can't go all the way to September and on demand. I can go to the 30th. So maybe we'll try this and see what these would be at. So another quick pause and check up on the chat. Does this make sense so far? What we've done? We've taken the likelihood of us hitting different targets here and here. G36 says, Anna Banana would like to hear. Okay, that I'll take that as an affirmative. To me, that feels like we know exactly what's going on. So now in order for us to make $75, we need the stock to hit $8.47 based on new volatility and whatnot. $8.47. And that's for $75. I just need to recompute the probability of hitting that. And we'll use that same time frame. So now we have 21 days to hit 847, which is about this 850. And the probability of hitting that is 65% of hitting that target. And then the probability of hitting this loss target will now be lower because it's further out of the money. The probability of hitting that is 14.8. 14.8. So now, if I show you this updated matrix, this makes a lot of sense. And it's not made a lot of sense because I feel like something is going to happen. This makes a lot of sense because mathematically, if I consistently deploy this way, it would make money. So now notice the emphasis that I placed on this specific point. Consistently. Because I just showed you in this one that this is a negatively expectant position. Yet, even though it's negatively expectant, it still made money. Because there is a 61% probability of this loss. That means that there's a 39% probability that this doesn't happen. So in this individual instance, this represents a smaller component, a smaller probability of this outcome, but that's what this outcome is. Kevin says, shouldn't sum both probabilities and profit loss equal 1 since there's 2 outcomes? It's a great question. And it really depends on how you choose to manage the entire position. So if I were managing this strictly as is, I would actually not sum them. I would create a composite with both of them so that it kind of automatically updates as I make these kinds of decisions, as compared to saying this, I want that $111 profit, which was like 18% or whatever. I would essentially just, you can sum these if you're so inclined right here. That's totally fine. Or I typically just do it as a composite ER. So it's kind of in one spot. Either or is totally fine. But the idea, exactly to Kevin's point, is to look at the total outcome here. So, but the broader point that I'm trying to highlight, and the reason why I'm looking at them separately, is because the way that we're managing these matters quite a lot. Because this is what it would return in the long run if you continue to do something the way you do it every time before. So what that means, well, let me take a pause. What does that mean? When I'm saying that consistency matters here and that this expected return is realized over the long run based on the continual application of something, Reese says, I'm lost on if we answered the original question. We did right here. So the original question here is, does it make sense to take the trade down early? Now, to Reese's earlier question, which it looks like it rolled off for some reason, I can't see it. But the original question was essentially, does that make sense to do? Or is it just kind of being emotional? And in this case, Reese was right, but for the wrong reason. Because his original explanation was, and again, this is a different scenario than Reese's trade. I want to be super clear about that. I don't know what his actual trade is. And that absolutely will change all of this as to whether or not it makes sense. So I just want to be super clear. But in this hypothetical scenario, based on Reese's scenario, if we had this case where now we're exploring taking early profits and maintaining that same stop loss with the lower probability, then it's a positively expectant decision if we continue to make that decision long term. So the important point here is when we're evaluating these kinds of decisions is that it's not even, does it matter for the individual trade, which does matter, but expected returns aren't realized on a single trade basis. Again, this is a great example of something that if this is done long term, based on these probabilities, this loss, this probability, and this win, it will lose money long term. But in this case, it made money. So when we're talking about expected returns of systems, it depends on the continual deployment of that system for a prolonged period of time for us to approximate towards this expected return. So I like to use them in these individual decisions to make sure that I'm not modifying something that decreases the total profitability of the system long term or turns it negative. And if it doesn't, then I'm okay with it. So that's exactly how I would answer that personally for myself. G36 says, much like casinos making 2 to 3% over many hands of blackjack. Yeah. And the funny thing about it is that for most casinos, especially if you can lay odds on something like blackjack, or I like to play craps because it's a little more active, but you can decrease the house edge if you're playing craps with that you can lay odds, depending on what the odds are. You can decrease the house edge to be sub 2%. House still has edge, but in a short term, you can make money. You can make a lot of money. The way that casinos make money, especially on those kinds of games, is over the long run. So the idea for a good gambler is to have an element of luck that you can create a bit of a streak. And then again, if you can do something smart, like counting cards, you can create positive edge for yourself. And then that's also realized over the long run. But if you're playing something like craps, there's no counting craps, right? It is what it is. So in that case, it's really based on duration. That's why when you're there playing craps, they give you free drinks. They'll come and ask if you want food. They'll fucking have some chick give you a massage if you're sitting at the table. Like, they don't want you to leave, because the longer you sit there, the more likely it is that your outcome is going to approximate to an expected return that in that scenario is slightly negative for you. So that's exactly it. Elon Song says, Eric, what is the title of this calculator? Wait, hold on. You mean what we built? This is just an expected return, but this isn't like I literally just made this calculator now. So it's not something that has like a specific title or anything. But what this is just a expected return analysis. So Zachariah's got a bounce. Zachariah, great to see you. Have a fantastic evening, homie. G36 says, I feel like I understand a lot of trading theory, but I can't implement it. My word is it's frustrating. Well, talk to me then, G36. Like, what is it about the theory / implementation that breaks down? So if you understand the practical, if you understand the theoretical component, where do we drop the ball? Elong Song says, I just need a filing place for my head. Yeah, okay, totally get it. I would just call it an expected return analysis for you, Liz. I think that will be perfect. And then also, yeah, for those that are in the Outlier mentoring program on the Patreon, I just sent out the email today to set up our sessions. So just general announcement for those folks. Tom says, do you need to account for the circumstances of the entry? Like, say I run a strategy on a ratio call diagonal where I top tick an entry versus bottom tick an entry. Keep going with that, Tom. Like, walk me through that scenario more. And then G36 says probably emotions and laziness when it comes to hashing out the maths prior to hitting the tape. Yeah, definitely. Because what I try to remind people is that when it comes to something like trading, if you have a base level of intellect, that's really all you need. Like, I'm not saying it even like being jokingly self-deprecating. Like, I'm not that fucking smart. So with that as the background, part of trading is being able to take a theoretical element and then apply it practically. So when I look at the largest differentiator for successful versus non-successful traders, it legitimately boils down to people who are able to deploy the skill set. Lots of people can study and know all the ins and outs of options and stuff like that. But it doesn't actually mean that they can deploy the skill set. So I think you're onto a really important point there, G36, but I would actually try to get more into detail on it if it were me. I would try to understand what specific elements are there, because let me show you this. On my website, if you go to resources, you can look at this page, trader decision making and cognitive biases. And you can read through all these different kinds of biases and decision making faults that we have. And then you can probably identify which of these you're most likely leaning towards. But I have to be honest, the easiest way to identify this stuff is by having a few conversations. Like if you pop in the Discord and chat with us a bit, or if you give me some more context here in terms of the emotional side, like all I would need to know is what's your approach to trading. And then I can probably tell you from this list what kind of things you have going on. G36 says, I've read them and memorized them and fall prey to them. Yeah, so talk to me. So give me a summary of your approach to trading. And I literally guarantee you, I can identify it for you live right now. It's not difficult at all. And then Tom says, because like you said, we're looking for consistency. Yeah, so Tom, that's why when we're looking, I see your question now. So that's why I track the expected return for things based on the strategy that I'm running. So for example, if I'm running a ratio call diagonal, not all ratio call diagonals that I run are built the same. So I track them based on the setup that I'm running. So for example, if I'm trading a ratio call diagonal in SoFi, and this, let's take a look at it. I mean, this is not what I would do it in, but let's just pretend it was. And let's say that I saw this run up, it ran sideways, came back down, and then I set a cap, something like this here. And let's say that my hypothesis was based on the price, consolidation I see back here, the way that it behaved around this same level through this run, and then it fell below that level. Let's just say that I conclude that this is an important price level. Let's just say that we're in here for this example, and I think that this is resistance. And let's say that I think if this is all armchair quarterbacking, we know what happens. Want to be super clear about that. Using it as a hypothetical for Tom's question. So let's say if we get a break above this level, I then want to trade it to the upside. For me, this is a breakout trade. That's the profit mechanism that I'm trying to track. And there's different ways to track or to trade a breakout profit mechanism. So the way that I look at stuff like this is I track the expected return for strategies, for profit mechanisms, and then essentially the cross between them. Because I can trade this profit mechanism would be a breakout. The strategy would be a ratio call diagonal. So I can track the expected return for the breakout profit mechanism, the ratio call diagonal strategy, and then the combination of them. Ratio call diagonal strategy for breakouts. And it sounds complex, but it's really not that hard to do. But Tom, that's essentially how I would account for it. I wouldn't worry so much like if I top tick or bottom tick something. That will come down to analyzing the profit mechanism and how good I am at identifying it. And if I'm not good at identifying it, let's say that you're trying to trade breakouts and you find yourself top ticking stuff before it drops. When you're looking at your trade log for that specific profit mechanism, it'll come out in spades. You'll see it clear as day that, on 35 out of 50 of your breakout style trades, the realized move after entry was negative X%. If you see that, it's clearly telling you outright clear as day that there's a problem with this approach. So Tom, let me know if that answers the question. The summary of that is I would simply track the expected return across two mediums and then overlap them for a third. I would track it by profit mechanism. I would track it then by strategy. And then I would track it then by the combination of profit mechanism and strategy to get more scalpeled. And then back to G36. G36 says, wait, Vladimir off. I love that fucking off Putin. That's so funny. Vladimir off Putin says, Eric, it seems that you recognize your strengths and utilize them. Math, statistics, organization, probabilities seem to be constant. We all have different strengths. Yeah, that's exactly correct. What I do is kind of based on whatever it is that I'm trying to build the skill set at, I try to figure out how to interface with it. So with something like markets, like I was explaining before when we first started looking at this, I'm actually not worried about SoFi hitting target XYZ necessarily, because if I'm trading something like long calls, I can still make money if it just goes up, right? I don't need it to go up all the way. So understanding that and the way that options behave and then coming up with a way to create probabilistic assumptions is really useful. Now, the way that I just showed you that other scenario, that's using what I call anchored probabilities. They're like targets, but there's actually continuum probabilities, right? Because in that example that we were looking at kind of a binary scenario. SoFi either hits 8 or SoFi hits 6.5 and I'm stopped out. It's either of those. But that's not the way markets work. You can actually develop non-discrete expected return calculations that take a range of probabilities. So those take a little bit longer to build, but that's a lot of times what I'll use when I'm trading zero DTEs if I don't have a stop, or if I have a really wide stop where I don't expect to get stopped out, or like a time management element. So I think for something like that, I find it really useful to use non-discrete probabilities, whereas something if I'm maybe trading off of specific targets, then having discrete probabilities is probably okay, I think. Okay, so G36 says strings of losers despite statistical edge prevents me from putting on new trade despite knowing losers are unavoidable. So from there, I can already tell you you're sizing too big. I also cut winners short, especially when trading position with short DTE, which also tells me you're trading too big. I have two methods, trading stock with relative strength and bullish setups, hourly charts, and have trouble managing trades due to fears. You have to give me a little more detail on the fears, but literally from that first bullet point that you give me, G36, I can immediately tell you your size too big if you're feeling that kind of way with those movements. I would bet money on that. My options trades are 2.5 total portfolio. Yeah. So it's not a matter of what the size is of the portfolio. It's a matter of how you react to the size. It's also what I tell my wife. But for this specific scenario, the 2.5% of total portfolio literally is irrelevant if whatever that dollar figure is it makes you feel some type of way. So for that 2.5% probability, or like total of your portfolio, make it 0.5%. The way I think about it is, let's look at an example trade. So right now I have a trade on in TQQQs. And I already showed you guys a bunch about this trade, like all these different, levels that I ran through, yada, yada, yada. Actually, I need to get rid of this because my current is here. I want like a stop below here. And so when I look at this, when I'm planning this trade that's gone through this cycle is when I started buying in. I bought it all the way through here. When I'm looking at the trade, the thing that I'm hyper focused on is how much am I willing to lose And does it make sense? That's what I think about. And it's not how much am I willing to lose as a percentage of the portfolio, but it's literally a qualitative assessment of, as I look at this, if I put this trade on and I lose 200 grand, if it goes from here to here, if I have an unrealized loss of 200 grand, how do I feel about that? Does that bother me? Does that not bother me? And depending on how I would feel about that, it would tell me how I would size that trade. If I would look at it and let's say under the assumption it's positively expected return, under that assumption, I would first say, okay, how do I feel? And I would say, okay, I don't care. All right, well then I'll size it within the corresponding bounds of the portfolio that makes sense. There's two elements to sizing. It's does it make sense for the portfolio? And then it's your reaction as a trader. So in this case, if the $200,000 unrealized loss here, I don't care about. Okay, so my reaction is then cleared. That's not a condition that I have to concern myself with. Then I need to make sure, does that $200,000 loss on this trade fit in with the broader portfolio? And if it clears there, it clears there. Now, another example, let's say that I put that trade on and there's a probability of me hitting a $200,000 loss down here. And let's say it fits the portfolio perfectly. Let's say that that risk is within tolerance. It's a small percent of the portfolio. So from that perspective, it's totally fine. But then if I think about that, I'm like, well, okay, if we have, just a couple bad days, it can get down there pretty quick. How would I actually feel about that as a trader? And if I look at that and I say, I honestly don't think I would react well to that. I think that I would get slightly emotional because I don't want to see that loss. So then even though it fits in the portfolio, I don't size it there. I would size it down. And then I would put myself through those paces and I would say, okay, what about a $150,000 loss? How would I feel there? Nah, it's still too big. How about a $100,000 loss? What do I think about that? It still would make me uncomfortable. What about a $50,000 loss? Would I be okay with that? Yeah, I think based on the total portfolio, what that amount of money represents to me, I'm okay losing that $50,000 if, that's what happens in this trade. I'm okay with that opportunity. So even though if going from that $200,000 down to that $50,000, if going through that process, now the position goes from 5% of the portfolio at risk to whatever the residual is. I don't know. Let's just call it less than 1%. I don't care, right? It is completely based on my ability to deploy the system. So if the system tells me I should size at a certain point, but going through the trade's life cycle at that size would lead to suboptimal decision making, then it doesn't matter if it's the optimal size if I'm going to suboptimally manage it. I need to find that balance. So G36, let me know if that helps, but that's the first thing I see there. Again, based on that first response, I literally can tell you that it's oversized. Vladimir Off Putin says, are you trading TQQQ shares or options? Both. So I'm using shares for the basis, and then I'm using options around it via something like a covered strangle. Now, again, I'm phasing out of this position because the reason why I built this position is because I was expecting kind of a parabolic up move, and I didn't know exactly how it was going to play out. And I also was traveling at this time. This is when I was gallivanting around Alaska. So I wasn't going to have time to babysit the options. That's why I chose to use the equity. But the longer term way that I prefer to carry this kind of exposure is actually through futures. So as soon as I finish unwinding, I've already unwound most of the TQQQ's position. What I have on left is super small. I have like 700 shares and 7 short calls against it. So for anybody that knows the way that I trade these, I normally don't have a 1-to-1 ratio of short calls to long shares because it caps my upside, but I'm literally trying to exit the trade. So if I get assigned right now, the short calls are at 66. If I get assigned there, I don't care. I want it. I'm looking to phase out of it, but I have to wait because right now the short calls are in the money. I don't want to close them for a loss unnecessarily. It just makes no sense because it's money that I otherwise would hold on to. So I don't want to go through that scenario. I'm waiting for time to pass so that I can either take those short calls down for a small profit and then sell the shares to the market, or take it into expiration if I have to, if it rallies a ton. G36 says, what DTE you sell on TQQs? Yeah, it's a good question. Let me tell you right now. For those right now, I have the 20 SEPs and I put them on 6 AUG. So it was at the onset, it was 45 DTE on the nose. So yeah. G36 says it does, but note my latest comment. Man, it's weird because when it comes to stocks, I can sit through larger dollar amount losses. That's because, again, the disposition effect. The idea of sitting through larger losses while you're holding stocks, again, if I grab that same study, this one, that is literally quintessential disposition effect. So sell winning investments while holding losing investments. So your tendency of sitting through bigger losses on your stock is literally just disposition effect. And I think because it's an unleveraged position that isn't decaying, that will give you a different reaction towards it. So yeah, that makes total sense to me that you would behave that way. So for G36, I agree with you. I think that you have kind of a slew of mental, I mean, the way that I would call it, again, just keeping it a buck. I don't mean the term offensively or anything, but I think that I think you have a slew of mental handicaps that a lot of us have to work through. But yeah, I agree with you. G36 says, yeah, dollar amount on stop loss. Yeah, so if it's the same dollar amount on a stop loss, that literally is just, it's pure irrationality, unless my guess is where the stop loss occurs. That would be the next question I have there, is if you're going to lose $1,000 on a stop loss, and let's say it's in TQQs, and let's say that stop loss in this case for the shares is down at 55. But then let's say instead, when you're using the options, because you're now leveraged, and that $1,000 loss occurs earlier, and that $1,000 loss is at 62.50, I would feel differently about that too. So my guess is having a variance in terms of same dollar amount of stop loss, that variance is going to stem from the probability of hitting the stop loss. It probably doesn't have anything to do with one being an option in that case or the other being a stock. My guess is if we look through your trade log, your options probably have the same dollar amount stop loss potentially, but at points that have a higher probability of being hit. So that would immediately make me feel different as well. That's my guess. Richard Diaz, yo, welcome to the Outlier supporter. I appreciate that very much. Thank you. Always good to have somebody join the fam. Roaring Clitty. Love that name, by the way. One of the best names I think you could have. Is what if you're trading small stacks and 20 sounds scary to lose? Asking for a friend. If 20 sounds scary to lose, then I think it's too small to trade that account yet. I would focus on building the account up, and I would focus on saving and potentially just putting that account into dollar cost averaging into something that you're cool holding long term, whether it's SPY, QQQ, IWM, combination thereof, whatever it is, so that you essentially eliminate the entire issue with the $20 loss being too big, and you simply just say, well, I'm going to dollar cost average into this for however long I need to, so I don't care if it shows a temporary loss. But if you're trading an account size where, you know, like a $20 loss still freaks you out a little bit, then it just tells me the account is too small, just straight up. and that will happen. Like that's not like the end of the world or anything like that. People go through that process, but that's my knee-jerk reaction there. And the other thing that I have no idea what to order for dinner. I was just realizing my wife is traveling for work, so it's just me. So now I have to just pick whatever I want versus picking something that we both want. That's a tough one. I'll have to consider it. G36 says pizza. I haven't had pizza in a while here, but honestly, like the pizza just is not that good. California pizza is sad. I really don't like it very much. So I agree with the idea, but it's just not worth it for me, I don't think. G36 says, gotta make it yourself then. I haven't made pizza for me before, so I don't know how long that process is. I like cooking, but not like that. Tom says, need that New York pizza. You know it, dude. Like, it's completely different. It's light years better. Yeah, I'll have to figure it out. Right now, I'm still trying to get my freaking phone case off. I like to take the case off once in a while, but the case that I have is like this carbon fiber thing, and it fits. It's so on the phone. It's nuts. Back up to the top though. And it looks like what DTE? We already answered that. Wait, Vladimir Off Putin says this is another issue for many retail traders who want to get into option 9:30 to 4. Is it bitch to manage options? Why is that? Oh, you mean because of like working and stuff? Yo, why can't I get this case off? This is crazy. I'm about to have to like break this. This is a stupid expensive case. What is happening right now? Apparently this is now like just part of the phone. I am shooketh. I have to like rip this thing off, dog. Get off my phone. Yo, I'm literally gonna have to break this. This is crazy. I like a slim fit case. I think they're sleek, but this is next level. G36 says C4. I literally was thinking, yeah, C4, a shovel. It's just on the phone now. I quit. It's literally not worth the effort. Get tacos? I don't really care so much for tacos. Tacos, they're really annoying to eat. They're like super messy. Hawk 2 on that thing. All right, let's get back up here. I actually, for Mr. Off Putin, I don't see the issue managing between 930 and 1600. I think for me, I think of it just as, especially when I was on like active duty in the Marine Corps, like I didn't have a bunch of time to trade during the day. I think you just have to modify what you're doing to fit the time frame that you're trying to do it in. Like that's exactly what I think about. So when I'm trading, when I was, on active duty, I wasn't trading 0 DTEs, 1, because they didn't exist, but 2, if I was still on active duty, I wouldn't trade 0 DTEs. There we go. I got it. Out of there. What a great win. Huge victory. Huge victory. So yeah, I would just modify the trading approach. And I think for most traders, actually a slightly longer term trading approach would do them massive favors anyways. I typically like to roll caseless with the phone, but I'll throw it in the case like when we're traveling and stuff, just because I always feel like the probability of a drop is much higher. But it looks like we're in action here. All right, so a couple other things. There's an exercise that I actually put the Patreon folks through, but it's a conversation that's come up a few times recently. So I actually wanted to do it with you guys and walk through with, literally just everybody that's interested in doing the exercise. So what I want is to pivot to that. However, I would love to hit anything else that you want to take a look at. So if there's any specific trades that you're looking at that you want to just get a second set of eyes on, happy to do that. Yeah, let me know what we want to do. Otherwise, I can start taking a look at the exercise. The exercise is not straight trading related though, just so you know. The exercise is a little bit built towards mindset. Hopefully it'll be useful, but I don't know. I hope so. So you guys tell me. All right, so Reese feels satisfied. That's good. I'm glad because we did spend a minute going through your stuff. I hope that that's useful for you, to be honest, because I think the process of sizing trades and then managing trades is actually so important. And I think a lot of it comes down to the way that we analyze information so that it's not like, none of this, in my opinion, should be guessing. It should all be, like I was talking about earlier, like just predefined management. And it all should be done before we enter the trade. So even if we're updating because we're getting new information and we need to start resizing things a little bit because we have new information, like all of that is completely fine and normal. And then in that scenario, I just make sure that the decisions I'm making are still logical. And that's the way that I think about it. So yeah, Tom says that was good. I'm familiar with the material, but need to go back and rewatch it. Yeah, what should I name I need to change the name. Normally I change the name to these like when we get on a specific topic like that. What do you think? Like expected return, trade expected return exercise. And we'll get into the other one too now. All right. So this next exercise, I'm kind of excited. And the reason why I'm excited is because this is one that I think I put a post on this recently. And I think it's something that, I don't know, it's something that impacts me massively. And it's something that I hope will be useful for you. And like I said, it's not specifically trading related, but it's this. So for some of the folks on the Patreon, they will have already seen this, but I'm not going to go through all of this like step by step. You can read through it yourself. And I'm just going to scroll through slowly so that you can always go back and rewatch the video. G36 says, what's the lowest time frame I use? Do you mean like for trading? And then Chris says, I think GME is going to hit 32 before earnings. What option should I buy? I have a video for you that will help you answer that question. Here. So for Chris, this one is for you. And for trading, I trade intraday. So I'll trade 0 DTE, like minutes. I'll trade all the way out to, I mean, much further than that. So yeah, the shortest time frame would be like 0 intraday. That is completely normal for me. I trade them almost every single day. Sorry, I meant for candlesticks. Oh, I go down a minute sometimes, but yeah, typically 5 minutes. I don't really watch them though. Yeah, to your next question of like, do you watch? I don't watch them. I'll look at like the broad picture, kind of the way that they're generally moving and stuff. But yeah, I don't actually like sit and watch either of them. Does that make sense? Whoa, holy shit. Generational capital. I'm ready to help you here, but that was like I don't know, the all caps is like a straight punch in the mouth. I don't know if I'm the only one that takes it that way, but That's what that felt like to me. It felt like I just got punched in the face. G36 says, yep, literally. Yeah, okay. I was wondering if it was just me. That is straight up. I felt like I just got straight punched in the face. Vladimir off Putin says it's shouting. That's awesome. Yeah, I agree with you. Let's take a look at this. So, get rid of that. Fan of airplanes, what up? Good to see you. Still haven't like really decided what's for dinner yet. And we'll figure it out. That's what I like to call a future Eric problem. Right now, I want to run through this exercise with you guys in a second. Wait, no, generational capital. Put your question back up. I was literally just about to look at it. Chris says, I think Jimmy, is going to hit 32. So let's take a look at that scenario really fast, because I'm just going to essentially summarize some of that video. Generational Capital says, was just trying to get questions answered. Yeah, I was going to answer it for you. I was just poking fun, man. Don't be so serious. Life is not that serious. Nobody's getting shot at. We're all going to die anyways. If you guys don't tell, or if you guys can't tell, I don't take a lot of stuff that serious because it doesn't warrant it. I take stuff serious that needs to be taken serious, and then pretty much everything else is overwhelmingly done in jest because it doesn't be serious. So let's take a look at the example we were just looking at with Chris GME, and he thinks it's going to hit 32. So then let's take a look at a few scenarios. Let's say, Chris, what kind of budget are we working with? What dollar size position do we want to put on for this example? And based on that, 5K. Okay. And of that 5K, are we risking the entire 5K, or are we putting on a total 5K position and then risking a small subset of that? 40%. So we're putting on a 5K position and we're risking 40% of the 5K. Got it. So now let's start looking at some positions. And the way that I want to look through these positions with you is, again, I'm not here to answer like what position makes sense for you, but what I am here to do is to walk you through how to evaluate some of these different positions and then to determine what fits your portfolio the best. So that's my goal here. Is Reese says, I love when it's not me in the hot seat. Well, it always can be, my friend. As soon as you're ready to step back in, just let me know. I'm here for you. So yeah, let's say that we're doing that 5K position and we think it's going to happen before earnings. Now, depending on the conviction on how strong I feel that it's going to happen before earnings, that will absolutely impact what I choose. So then the next question, Chris, for you is, how convicted are we? Are we thinking like, yes, I am like very, very near certain that this is going to go down like this, or what? Based on that, it'll change what expirations I use. So for example, if I think that there's a really high probability that it's going to happen, then I would weight my options to closer expirations. If I think that there's a lower probability that it's going to happen directly by then, but maybe sometime around then, I'll put a little more days on those options. 70% conviction. Okay, so that's like super convicted in my world. If I'm 70% convicted, that's like very, very high leaning. So with that, we can structure something that, and next question, Chris, is are we trying to optimize for profitability? Meaning, do we want to optimize for total amount of money we can make? Or do we want to optimize for the probability of making a positive return, even if it's slightly less than total profitability? The reason why I ask this question is because it will determine, again, slightly what expirations, but this is going to start telling me what deltas I'm going to use. Positive return. Okay, so we're not necessarily looking to make as strong, like the highest return possible, but we want a generally high probability of making a positive return. So with that scenario, I'm going out to 18 oct for the base position, and we have $5,000 to work with. So then I'm looking at these 22s that are 65 deltas. I get them for 380 bucks. So then I put on 10 of those. So now I'm using 3,800 bucks. And then I'm going to add 20 SEP. And I'm going to add maybe 30 deltas. And then we have what we use 38. So we have 12 left to go. So these are like 115. So that's about what I would look at if I think it's going to hit 32. If it hits 32 in this case, I'm putting up $5,000. I'm making 11,290. And the probability of profit here is as long as GameStop essentially goes up even a little bit, you make money. And then for our, we have a 40%, and this isn't going to work the same for these options, but we have essentially have a 40% downside. So that puts us at like 2K. We hit a 2K loss if we drop to 21.08. So now I can take a look at the probability of hitting these. So the probability, let's say over the next 20 days of hitting 21.08 is like 74%. So really high probability. And then the probability of hitting 32 is like 20% based on current options. So again, this is based on, this is using just the probabilities. If we have some sort of really strong conviction for some reason, then slightly different scenario, but that's what I'm going off of. Essentially this really high conviction that we believe that this is going to happen. So with that really high conviction, that's what I see here for our probabilistic assessment. So we can do the quick math out of curiosity and just see what the expected return looks like even in this scenario, because believe it or not, it might not look as crazy as you might think, because it's it's such a skewed. So we can get rid of this. So normally I would reorganize this a little bit. This would go here. This would go here. Go here. And again, I'm literally using the calculator that we just built so that you can see how we can use it in this scenario. So our profit target in this case is 32 bucks. And we just looked that there is, again, our options are out until 20 SEP. So the probability of hitting 32 is about 20%, I'll give it. And then our stop occurs essentially at 21. And then the probability of that stop, again, by this time frame of 21, right there gives us maybe a little under. Yeah, so we'll call that like 70. Now the probability here of that loss is 2,000. And then the probability of profit in this case was like 12,000 or 11,500. So this is still a positively expected strategy. That's the cool thing, is you can have something like this that has an exceedingly high probability of losing. And because the probability of profit at our probabilistic target is because the profit is so high, it's positive ER. Now, with something like this, the important point to consider is that you're going to lose on this trade a ton. You're going to lose a lot. Like the vast majority of times you put this trade on, it's going to lose. But in the long run, if this style of trade, whatever the specific strategy is continued to be deployed as designed, over time, it will make money. But that's kind of that's the way that this works, is that it's over the long run. So typically I would also conditionally format this so that if it's greater than 0, we'll make it green. And then if it's less than 0, I'm just showing you this in case you want to format yours, make it red, something like that. So yeah, this is essentially the way I would think about it. Now, the way that this trade is structured, for those that's curious about why it's built this way, is I'm building a core position that's a little further out in time, and that core position will move a little more slowly. It won't compound quite as much, but it is kind of the backbone of our profit. So in this case, if we get that move to 32, those 22 calls that we bought that were slightly in the money, they're going to make about $6,800. And then on those 28 and a halves at 32, they'll make $4,480. But obviously you're putting up a much smaller amount of capital to control the same size, right? So in this case, we're putting up $1,150 to control the 10 lots, which that's your 1,000 shares. And then compared to this one where it's, $3,800 to control that same number of shares. But the difference is these are going to start making money faster in case you don't get a move. The reason why this is important, and the reason why I structure it this way, is if we just did a bunch of these closer DTE, further out of the money options, watch what happens as I fast forward time. You'll see that at current spot price here, let's go back again, start it again. So at current spot price here, the trade is essentially neutral, right? I want you to look at this row here. So the trade is neutral. If I fast forward one day, you wouldn't actually make money. So if I go forward 2 days to make it more accurate, you'll lose $52 right out of the gate. If nothing moves, you lose $52. Then another day you lose $122. So the theta decay on these options is gnarly. So if we look at this deeper in the money one to start, after 2 days, you only lose $25. You lose half of what you lost in the other scenario. Add another day, you're only down $58. Whereas again, in this scenario, you're already down $122. So this serves as a little bit of an anchor and an offset. Because now if we do get a small accommodating move, let me change these slices to be like 5% steps. So if we get a positive 5% move, in this case with both combined, you'll make $984. If you do just those out of the monies, you make $252. And the reason is because as time passes, theta is going to eat more and more and more of the residual value of those options. So even though you might get an accommodating move, if it doesn't happen fast enough, you're literally being decayed away. So by including these longer dated options, you add something to help you overcome if you get a move in your favor. So the way I would look at something like this is the way I would generally set something like this up. However, if I was somebody else and I was really, really convicted on this, out of the money option scenario, you can always pare down this a little bit, do 5 of the in the monies that are a little further out, and then scale up the residual position here. If you're so inclined, you can do something like that. You'd actually need a little bit less than this, but whatever. Actually, no, you're okay there. You can do that. So yeah, just you can oscillate between these a little bit. All right, so now I want to go back to Generational Capital's question. And they're asking, can you put a stop loss on a multi-leg option? Definitely. So let's take a look. Let's use Generational Capital. What product do you want to look at for this? And I'll happily grab it. Otherwise, I can just come up with one. And the question is specifically for credit spreads. Okay, so let's take a look at SPY. And then let's take a look at credit spreads. So if we take a look at a short-term put credit spread, so let's do like this 3-step, something like that. And then let's do like this 562, 561, which is negatively expectant straight from the jump, which I don't like. So from the jump, I would not trade this for, same thing for the $2 wide, that's negatively expectant. And the $3 wide is also negatively expectant. So all of these are negatively expectant, but the better one here was actually the $2 wide. So looking at this $2 wide, essentially the way that we would put on a stop is super simple. Let me go into on demand so that I can actually like show you the mechanics of the trade. So if we go to 0 DTEs, it's just got to load for a second and then we'll take a look. Okay, cool. So now if we take a look at these 31s and 23s, again, these are negatively expectant. I don't like them, but let's just play the game. Put these on. Maybe. There it goes. Boom, we got a fill. So here's my trade. I would just hover over that trade, create closing order, buy one vertical, and then put a stop. It can be a market stop. If the premium hits a certain point, that's up to you. Or you can do a stop limit. So if the premium hits a specific point, you want to set the trigger. And then if you can't get a fill within your bounds, then it won't fill. So the risk here is that if you do that kind of thing, then you run a bunch of different problems realistically doing this with a spread, but this is the process that you would do it. Now, the issue that you have with putting a stop limit on a spread or really anything is there's a probability that you don't get filled. So for me, I actually would argue in the vast majority of instances, is like that's kind of one of the points of trading a spread is to define the risk. Now, if you're trading the spread more as like a capital reduction kind of thing, so instead of doing this dollar wide, let's say you wanted to sell this 559 and let's say you wanted to sell it as a naked put, but your account just can't handle that value, I would go further out of the money, grab something like maybe these 554s or whatever your account needs, but I wouldn't mentally be trading this as a spread. Like this is literally just here to manage the capital, and this is the base position. So it's the same thing though. You can still set your order just like this. The tricky part is that getting a fill, especially in something like this, especially if it's towards something like the end of the day, you can get stuck. You can get stuck bad. So it's really important to treat stops and stop limits with respect, even if it's not something like this. And it's like anything that you're choosing to trade short-term time frame is going to have higher volatility. As soon as you start adding spreads, there's more legs that have to be fulfilled in order for the order to go through. So it just runs a lot of slippage risk. And I posted in the Discord not too long ago, I was providing like a trade update for, I forgot who it was. Oh, it was just in the trading floor. Yeah. So for the Patreon folks, every once in a while, I'll post like some of the trades that I'm doing. And one of the things that I was doing was a 0DTE SPX trade, but unlike you, Generational Capital, I'm just doing it with like short strangles, but I use stops. And some of the times what'll happen is in a strategy like that, let's say we grab SPX here. And let's say that I want to put on this short strangle. We'll see where it loads to. And let's say we do like this 16 delta and then this 18 delta, whatever. So we're going to collect 650 here. And then let's say that, you know, you want to get out at 2 times your credit received, whatever that is. So that would put you out at 13. Whenever this trade's at 13. So let's see if this trade will go through. It didn't. Let me try one more time because I just want to show you the closing mechanics. Let's just try doing like a market order. Oh, it won't let me because, see, that's one of the things I hate about this is that paper trading doesn't let you use portfolio margin. It automatically assumes that you have Reg T. So this is a $100,000 account. I don't think it can support this position. That's annoying. So anyways, let's pretend that this trade was on. And what'll happen for 0DTEs, especially as things become more volatile, if I choose to put a stop limit to get me out of this trade. So in that case, it would be a buy. I'm just pretending to reverse the other one. And let's say that I do a stop. I just do a stop in this case because I want to make sure I get out. And I'm supposed to get out when it's at 13. Well, the problem is that as soon as the mark price hits 13, it's going to fling my order out there. And if we're in the middle of a really nasty move, I literally have had fills 2 to 3 times what my stop is on a market order. So what that means is I might be planning to get out when this is at 13, but I might actually get out at like 20 because that's the next order. That's the danger of using a market order for your stop. But pick your poison, because if you use a stop limit, and let's say that your stop is still going to be triggered at 13, and let's say, well, I don't want to get filled worse than 14. That's bullshit. I shouldn't get filled worse than that. Well, guess what? If it goes past 14, you're still in the trade, dog. So as this thing goes from 13 to 14 to 15 to 18 to 20 to 22, wherever it decides to stop, you're not out. So you didn't get a worse fill, but you didn't get any fill. So you have to pick your poison. Whatever you decide is more so integral to your strategy and the way that you manage risk. That's the way that I think about it, because it's actually really frustrating that sometimes you'll get like terrible fills like that, but that's just part of the game and you have to pick whatever makes sense for you. So in the case here, that's why when I'm trading something like, I don't know, for me, something as simple as a vertical spread of some sort, well, in that case, I would literally just leave the vertical on and I would size the vertical to be whatever I want it to be. And then just let that be. Just use the vertical. So yeah, it's kind of brutal, but yeah, you have to pick your poison. Generational Capital says, thanks a lot. Really appreciate it. I'll keep watching and learning. Sorry, but oh, dude, seriously, don't worry about the all caps. It literally was just a joke. You could type in all caps until your heart's content. Yeah, literally, I was just joking. It's nothing. It's not a big deal whatsoever. Do not worry about it. Tom says, does it make sense to put a stop for each leg in a strangle instead of for entire strangle, then go and close the other leg, which should be profitable? Well, think of it this way. If you set a stop, it's automatically going to close the other leg profitable, right? So if I put this strangle on, let's do a stop. And let's say that I want to close the trade at 13. Well, what's going to happen is as this trade goes to 13, whichever one it is, let's say it's going down to the put side, that means that the puts are now essentially at the money trading here worth essentially 13. And then these would be really far out of the money, essentially trading for a nickel or something. So it's almost the same thing, but you could do each leg. You can even submit an individual order for each leg if you're so inclined, which is kind of important if you're going to hold the stop into the close. Because another experience I had with 0DTEs is I had a stop on and it was hovering right at my stop price. And it was just a stop. It wasn't even a stop limit. It was a stop market order. So it should have gotten filled, but it didn't because it was just before the close and nobody was buying my really far out of the money option. So even though my number got hit, there was liquidity trading on the side that needed to be stopped out. It didn't matter because I didn't get a fill because nobody was willing to trade the super far out of the money, which is very frustrating. Tom says, tracking that, but you would be more inclined to get a fill faster for each leg or no? Because when you put in a stop for a strangle, it's obviously looking to buy to close both legs. Exactly. And that's kind of the point of the story that I just shared. So I think that risk becomes the greatest if you're holding the stop into expiration. And then in that case, you can transfer it to be an OCO. So I can do one order that I submit that then cancels another order or triggers another order. So in this case, I can do whenever one of these orders occurs, let's say it's a stop, and the stop is for, again, whichever side of the trade, you could do it on both sides. So whenever that stop is hit, it triggers another order, which would be to close your other position. Again, I can't do it in this interface because it won't fill the trade for me. But you can do those so it's essentially tying the individual orders together. But exactly to your point, it saves you the liquidity issue. For me, I just am not taking them into expiration anymore. Because one of the things I've noticed with 0DTEs writ large, and I was in the process of doing study on it, actually, I'll take a note because I'm home alone now. I have even more time to just play and look at nothing. So I'm going to analyze EOD SPX moves. I'll share that. I'll share that. Yeah, whenever I have that study, I'll put it into the Patreon so you guys can take a look at it. So yeah, that's that. All right. So we ran a little bit astray. We didn't really get a chance to run through this. So I would love to go through this with you all at some point. Essentially, and again, the reason why I'm scrolling through it is if you want to take a look through it yourself, you can. You can like just run through the video and pause it. The whole point of this exercise is to kind of confront ourselves and to take the time to like truly identify what matters to us and what doesn't. So the origin of this is during COVID, I was going through a kind of a bit of a scenario where I generally lost my way. And it was weird because I started like realizing all of these different financial targets that I had for myself. And I had already exceeded a lot of them. And that led me to a point where I was kind of confused as to like, what's the point? What am I looking at now? And I know that it's a really high class problem, right? Like how cool is that to essentially hit your goals? But it's also slightly troublesome because when I was looking at it, I was like, damn, like, am I actually hitting my goals or did I just guide down my expectations so far that I can essentially just step across the goal, right? Because for me, I think that there's a balance between two things. The first thing that we have to balance, at least for me, is the desire to grow. I think aspirations and I think pursuing growth is good. But I also really respect the stoic methodology of managing desires and limiting how much I desire something, right? Those are two philosophies that I really, really believe in, because I've never seen somebody accomplish great things that's not ambitious, that's not trying to do something or achieve something. But then I also know that the Stoics are extremely wise, and they talk about this discipline of limiting your desires so that, again, you're not essentially left wanting more and more and more and more and more. So the whole point of this specific exercise is to help me identify that balance. What are the things that I truly desire? And then what are the things that I can essentially limit the desire so that it's not part of what I'm looking to achieve or push towards? So that's the point of this exercise. Again, we won't go through it tonight because we're kind of out of time, but I was talking with a buddy at the gym this weekend who was unfamiliar with this concept of marginal utility. And as I was talking with him at the gym, he even texted me afterwards. He was just talking about like how eye-opening the whole thing was. And once I got his response that he was explaining like how eye-opening it was, I was like, okay, maybe this is something that I should put in front of other people. Because again, like before it was just for the Patreon folks, but if it's something that like really meant something to him and he's a smart dude, then I'm thinking maybe other people will derive benefit from it. So that's why I'm kind of sharing it here. So maybe we'll go through this on the next session if we're interested. Like if we're looking at this and you guys are like, yeah, okay, whatever, bro. Like I don't fucking care about your mental bullshit. That's cool. That's honestly totally cool. We don't have to spend any time on it. But it was something that was fairly transformative for me. And it seemed like it was something that was making him also think differently. So I figured I'd put it in front of us, see, again, if it's something that we want to go through, and then we can spend a little time. Because what I do in the exercise is I give us like different scenarios, right? So there's a scenario where we have essentially just minimal resources. Then there's a scenario where we literally have unlimited resources. And then there's a scenario where I kind of use whatever my current trajectory is. And then I think about what I would prioritize in these different scenarios. And then I come up with like a series of questions about what I would do, how I would do things. And again, it's to help me try to bracket down this exact top part, is identifying what I truly value. Because for somebody like me, I actually tell people all the time, like having exotic cars is a giant waste of money, a colossal waste of money. But for me, I really enjoy automotives. I have a lift in my garage to work on cars. My Corvette is on it right now. So for me, the marginal utility of having the Corvette right there that my mother-in-law, she painted that I get to build is big marginal utility for me. The McLaren that I bought, it's like pure marginal utility for me. Now, for somebody else that's trying to buy an expensive car or something like that because they think somebody else's perception of them will change, what an absolute colossal waste of money, because that car is really expensive and you have zero control over people's perception of you. So it deserves very little of your time beyond the people that are very close to you. I think their perception matters quite a lot. It kind of keeps us centered. So this exercise, I use it to help me find that balance. I want to understand the stuff that I really want and value and derive significant marginal utility from against the things that essentially, if I had unlimited resources, I would get simply because I would get, like one of the examples in here is a yacht. Would I buy a yacht if I had unlimited resources? I would. I genuinely would. Because why wouldn't I buy a yacht if I had unlimited resources? But would I buy a yacht with my current trajectory resources? And the answer for me in that scenario is no, I wouldn't. Because although the yacht would be cool, and if I had unlimited resources, it's a why not scenario. in my trajectory resources scenario, I have to analyze the amount of time it would take for me to create the capital to purchase and sustain that asset, or liability in this case. So then it's a cost benefit analysis based on trajectory resources. So I think it's good to kind of acknowledge to ourselves the things we want, because I feel like, especially in the US, in Western society, you're taught that if you aspire to money, or if you aspire to things, that you're automatically materialistic and that you're focusing on the wrong things. You should just focus on doing good and not how much money you have. And I think about it differently. I think that you should focus on doing good. You can, but I also think you should focus on creating an abundance of resources, because there's a lot of really cool things you can do when you have an abundance of resources. I was just telling my buddy, we went out to grab dinner, and when we're at dinner, like, we got a bill, I think it was like $100, and I tipped the person $50. And why would I tip them $50? Well, it's because one of the cool things about having a level of abundance is to be able to share with other people. So I think that there's nothing wrong with looking for healthy abundance and acknowledging the fact that it's okay to have desires and stuff. I think it's a disease to be materialistic. And I think that if you think that material things are going to make you happy, I literally guarantee you they won't. They will not. But what I can also guarantee you is that if you're happy before you have money, when you have money, it's just a massive amplifier. Everything's a fucking blast at that point, because now you get to do a lot more things. So there's nothing wrong with wanting money. I think it should be in context, though, and always in balance. So that's my pitch for the money mindset and marginal utility exercise that I want to run through again a little bit deeper. We have a pro live session tomorrow, so then we'll probably do it on the Wednesday live stream if we have time. Again, I'm not looking to force this down at anybody's throat if they're not interested, but it's been really useful for me, so hopefully it will be for you. All right, gang, that wraps me up. Absolute blast. I had fun looking at those couple scenarios with you all, those kind of practical explorations. They're really, really fun for me. So, and I hope that they're useful for everybody else. Tomorrow, the markets are open, so we'll see what's going on. Be an outlier, and I will see you all later.